Welcome to the ETF Market Insights, your regular webinar series that focuses on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights with the goal of helping you become an informed investor. Make sure to visit www.youtube.com/ETF Market Insights to watch previous episodes, and remember to hit subscribe so you receive a notification when we post new content. Thank you for joining us today. Let's get started.
I'm Danielle Nazzle with BMO ETFs. Thanks for joining us today on ETF Market Insights. Before we get started, I would love to introduce Alfred Lee. He's a director, portfolio manager, and overall ETF expert. He works with me at BMO ETFs. We are going to break down rising rates for you today, and we're going to talk about how that's impacting markets, how it might be impacting your portfolio, things you might look for, things you can expect as rates continue to rise, and then some ETF ideas to hedge against this rising rate environment. So a lot to unpack. But as a reminder, we are not providing any recommendations today. We are not providing any advice. Today is all about giving you, the audience, the information you need to navigate this market environment and to manage your own portfolios to your specific objectives. And if you haven't yet, make sure you click subscribe on our YouTube channel. We're really excited. We kicked this off this year. This is a spot where we post all our episodes. So if you're not watching live or you missed the live episode, you can check out YouTube or go back and watch previously played episodes. There's a great library of content there waiting for you. So click subscribe. It really helps our channel grow. Today, I wanted to highlight a tool or resource that's available to you online. And this one was shown to me actually by my brother-in-law, who's a rate strategist. And this is a site he goes to quite often, and it's Rate Spy. So today we are talking about rising rates. This is a really, really good resource for you to go every day that's updated. If you're thinking about mortgage rates specifically, and you'd like to see how rising interest rates overall are affecting mortgage rates, this is a great site for your own research, but it also gives market rates as well. So here I put up a few on the screen. So a really, really good tool, and it's free to use, and if you'd like to check it out. Now, Alfred, I think our conversation today is about rising rates. And when we talk about rising rates, one of the first things we always cite is the yield curve. So for the audience out there that might not be familiar with understanding the yield curve and how it moves, can you talk to us about how's the yield curve reacting to this rate environment and maybe what investors can look for as the yield curve shifts and changes?
For sure. First off, great to be back on the Market Insights call. Always fun to be on this webinar. But in terms of the yield curve, there's a lot of insight that you could get from the yield curve. It's essentially the market's expectations for what they anticipate for yield curves over various terms. But it tells you a lot in terms of what the market expectations are, just not only in terms of what their interest rates are going forward, but the shape of the yield curve could also tell you a lot of information as well. So a lot of people always look to see whether the yield curve is steepening. So steepening meaning that short-term rates are going to be lower than long-term rates. So that essentially indicates that the economy is expanding, just because they anticipate that some point in the future, the central banks are going to raise rates in order to cool off the economy. Inversely, when you get a inversion of the yield curve, meaning that long-term rates are lower than short-term rates, that essentially signals a recession, because it indicates that the central banks are going to lower rates at some point in the future in order to stimulate the economy. So, when you look at the yield curve right now, there's a lot going on. Over the last year, we've had almost a parallel shift in rates going up across the yield curve, given that the economy has improved, we have inflation, and we have tightening from the central banks. But there's a lot going on right now. It's a very dynamic yield curve. There's a lot of forces pushing it down, but there's also forces pushing it up as well. So just to quickly go over What's holding down rates right now is obviously the tensions out of Russia and Ukraine. On the back of, the last couple of weeks of February, we saw a lot of institutional investors start buying, especially in the long end of the curve, to try to hedge out the equity parts of their portfolio. So because of that, as they were buying long bonds, they essentially, push prices up, yields down. So that's why when you look at the yield curve right now, the light green line, which you'll notice is that the end of the curve, or the long end of the curve, is essentially a little bit inverted. And that's why, because we see a lot of investors essentially buying long bonds right at this point to hedge out their portfolio. On the flip side, however, in terms of what's raising rates, there's a number of different factors. So there's inflation, obviously. We saw the CPI rates come in higher than expected, or not higher than expected, but on the rise over the last couple of months. We have central bank tightening as well. The Bank of Canada and the Fed have been raising rates. Also, we have COVID essentially being relaxed at this point, where a lot of economies are learning to live with COVID. So one thing I want to note is that one major news item over the last week was the inversion of the US yield curve. So the 10-year minus the 2-year yield essentially inverted, and that typically is a sign that we are potentially going to get a recession over the next couple of years. The good thing, however, is that it only lasted a couple of days. Now it's back to being a steepening. So hopefully that's good news, and we avoid a recession over the next couple of years.
Thanks for talking us through that, Alfred, and just such a good visual, and I appreciate you pulling this graph for me. Looking at that dark green line, that's the expectation for rates today, and you can really just see how it's so much steeper in the short end of the curve, showing that rate expectations are so much higher than they were a year ago. So that is the yield curve for you, your yield curve 101. So here's another data point or graph that you pulled for me, Alfred. And this is also showing market expectations. So what is the market saying about how high are rates going to go? Are we going to see 1980s type rates, or what are the expectations here?
So very aggressive assumptions at this point. So this is basically a function on Bloomberg called world interest rate probability. So it essentially uses the overnight index swap market in order to price out what the market is anticipating for interest rates going forward. So a good thing about this is that it essentially gives you the market's insight in terms of what investors are thinking for the next several Bank of Canada meetings. You could also do this for the Fed as well. But what we did was we pulled it for the Bank of Canada. So over the next 6 meetings, so the remainder of the calendar year, the market is anticipating 8 more rate hikes. So that's very aggressive assumptions. Keep in mind that there's only 6 more meetings for the calendar year. So if the market is correct, that means at least 2 of those meetings, we're going to get a 50 basis point rate hike. One thing to keep in mind is, as you pointed out, this is the market's expectations. That doesn't mean that this is what's actually going to happen. In all likelihood, potentially the Bank of Canada, what they could do is after a couple of more rate hikes, potentially after the July meeting, after the September meeting, what can happen is that they can take a pause. Keep in mind, anytime there's a change in monetary policy, it does take 3 to 4 months for the effects to trickle down into the economy. They could potentially take a pause and see what happens. At that point, they could also use forward guidance as a tool as well. After making a couple of successive rate hikes, the market will give them credibility, will take them seriously. So they could say, what, we're going to take a pause here, but somewhere down the road, we're going to start increasing rates. So forward guidance is a very effective tool as well, because it allows them to control inflation, but at the same time not choke off economic growth. I think the key point here is that the central banks don't want to overshoot, given that if they choke off economic growth but not inflation, they cause a much more dire scenario, which is stagflation, which is a combination of a stagnant economy and inflation as well.
Really interesting balance that they need to kind of think about, right? Economic growth versus trying to dampen inflation. So we'll keep our eyes on that. Now, here's a term that we haven't heard in a long time either. So we've heard so much about quantitative easing for the last couple of years, but now we're starting to hear about quantitative tightening. Alfred, what does this mean, and how is this going to affect the markets?
Yeah, that's a good question. I mean, I think, as you pointed out, a lot of people have been talking about quantitative easing, or how they call it, QE. Quantitative tightening, not as many people talk about it. It's essentially the opposite of quantitative easing. A lot of people call it tapering as well. But whereas, quantitative easing, essentially the central bank goes out and buy their own bonds. So they could target certain parts of the yield curve in which they're buying their own bonds. They could buy the entire yield curve as well. So that's essentially what we saw with the Fed after 2008. After the lockdowns of 2020, Bank of Canada also did it as well. So essentially what they do is they buy bonds across the yield curve in order to flatten out the yield curve in order to stimulate growth, keeping yields low. So quantitative tightening, essentially what they do is the opposite. They slow down their pace of buying. So the Fed essentially announced earlier this week that they're going to shrink their balance sheet by 95 billion a month. So the effect of quantitative easing, as I pointed out earlier, is to keep interest rates low. Quantitative tightening obviously is going to have the opposite effect. So we found this chart online, a very interesting chart. A little bit confusing at first because it plots interest rates upside down, but what they're trying to do is show the correlation between quantitative tightening and the effect on interest rates. So as this line is going down, that essentially means interest rates are going up. So this is a chart of what the Fed was doing pre-pandemic when they were trying to tighten up their quantitative easing after 2008.
Thanks for showing us this, Alfred. So just kind of to summarize, we've just been through a quantitative easing regime where they're buying government bonds, and now they're going to stop buying. We're entering this quantitative tightening regime where they will be shrinking that balance sheet and selling off some of the bonds that they've acquired. So Alfred, fixed income 101, I guess, rising rates mean that bond prices usually go down. Can you talk us through this kind of inverse relationship, what rising rates mean for the bond environment, and then maybe talk us through this last quarter, because I know we did see this has been a very tough quarter for fixed income.
For sure. So just in terms of bonds, higher rates are obviously not good for bonds. And the reason why is because, think about if you're buying a bond at a 3% coupon. So you're going to earn a 3% coupon rate or an interest rate over the year. However, a couple of months later, interest rates go up and all of a sudden the new prevailing bonds are paying a 4% coupon. So, the bond that you bought at a 3% coupon is not going to be as attractive. So what has to happen is that the price has to adjust downward for the yield to adjust upward to 4%. The current yield has to be at 4% to make investors indifferent between that old 3% coupon bond and that new 4% coupon bond. So that's why higher interest rates are not good for bonds. But essentially, yeah, so bonds are very interest rate sensitive, whether they go up or down. Higher interest rates is good for or not good for bonds, whereas lower interest rates are good for bonds. So in terms of the last quarter, obviously interest rates have been going up. That's had a negative impact on bonds. Over here we highlight some of the worst quarters for the bond market historically. Not all of them have been interest rate driven. I mean, for example, Q1 2022, that was more driven by the pandemic. That was a very stressful point in my life, given that I was trading bonds at that time. But what I would point out is that with the bond market, it's never had 2 consecutive years of losses historically. So we potentially may see that for the first time ever. So it's going to be very interesting to see what goes on for the remainder of the year. But what I will say is for the bond market is what we're seeing at this point is a natural recalibration of the market. So as bond yields continue to go up, at some point, think of it if you're an equity investor or an asset allocator, if yields continue to go up, at some point, equity investors are going to look at those bond yields and say, hey, you know what? I'm going to be willing to forego the growth in equity markets in order to lock in that yield in the bond market.
Which has less risk than the equity market. So interesting kind of risk reward payoff and how that changes as yields rise in the fixed income space. What about, Alfred, what about duration? So rising rates affects bonds differently based on how long that they're issued or what their duration is. A lot of investors out there holding fixed income might be aware of the duration of their fixed income portfolio, might not be aware. What are some things these investors can look for, and just let us know how these rising rates affects duration differently?
So duration is essentially, just to walk through the basics, it's a measure of how interest rate sensitive a bond or bond related product is. So, bond related product being either a bond ETF or a bond mutual fund, those are going to have a duration. So duration is closely related to the term to maturity for a bond. So longer dated bonds tend to be have more duration or tend to be more interest rate sensitive. So think of it this way. I mean, if you buy a bond with a 5% coupon, 5 years until maturity, and there's another bond that pays you an equal coupon, so 5% coupon, but over 10 years, that longer dated bond is going to be more interest rate sensitive because over the next 10 years, we don't know what interest rates are going to do. So you've locked yourself into a fixed rate for a longer period of time. So they tend to be more interest rate sensitive if they have a longer term to maturity. So how you read this is essentially, when you look at the Canadian bond market, it has a duration of 7.8 right now. So how you essentially use that number is that if rates go up by 1%, that means that bond or the bond market is essentially expected to drop 7.8% for every 1% increase in interest rates. And conversely, if interest rates go down 1%, the fixed income market is expected to go up 7.8%. So that's how you use duration. There's a number of ways in which you can manage duration risk or manage interest rate risk. So just pointing to these corporate bond ETFs as an example, these are all corporate bond exposure. So what we do is we break it into short-term bonds, mid-term bonds, and long-term bonds. So all of those will have different duration risk. So all this, take for example, if you're holding ZLC, which is the long corporate bond ETF, if interest rates are going up or you anticipate that they're going up, one good way to manage that duration risk is you shorten up the term to maturity, go into ZCS, which has a duration of 2.7, which is going to be less interest rate sensitive.
Such a good point, and really, it's just showing how ETFs give investors at home the ability to manage a portfolio, how an institutional manager would manage a portfolio, that ability to maintain that credit exposure if that's what they want, but just shift into a shorter duration versus a longer duration, depending on market environment. I think it's just so powerful. ETFs allow investors to do that. So thanks for pointing out duration there, Alfred. Now, what about credit spread? So I know last year we were talking about as things started to recover, credit spreads got really tight. But here we can see on this chart, credit spreads are now widening. So what does this mean for the credit space?
So credit spreads are essentially a measure of default risk. So keep in mind, if you're a bond investor, there's two main risks you have to account for. There is duration risk, which we talked about, but then there's default risk, which is the other concern. So credit spreads are essentially a measure of default risk. So the way you kind of think of credit spreads is essentially if you buy a corporate bond or any bond that has credit risk, you want to get paid an additional premium above and beyond a risk-free security, which is typically a government bond security. So if you buy a corporate bond that is, has a coupon of 7%, but a federal bond with the same maturity is yielding, 2%, that means that credit spread is going to be 5%. So it's essentially the difference. But that credit spread will change over time. So as economic conditions sour, or if the default risk for that issuer becomes more uncertain, that credit spread will widen. And conversely, if things improve, they will tighten. So credit spreads are a good indicator of default risk. One thing a lot of investors have pointed out over the last couple of weeks is interest rates have gone up, and typically when interest rates go up, that typically means the equity market is going up as well. Not all the time, but typically, because as equity markets go up, the yield on bonds have to go up in order to entice equity investors into the bond market. So over the last couple of weeks, questions have arisen saying that, well, rates are going up. Does that mean that the market is forgotten about all the risks going on in terms of Russia and Ukraine? And the answer is no, because when you look at the credit spreads have widened since the end of February when that invasion started happening, and they still remain wide at this point as well. So interest rates are going up because of inflation and central bank tightening concerns, but the credit spreads are a better indicator of that geopolitical risk in the market.
So Alfred, you've just set the stage so well for us. You've talked us through, how credit spreads look. You talked us through duration, market expectations of interest rates. So now for a bond investor, someone who's managing a fixed income sleeve in their portfolio, what can they think about, or how are some ways they can think about navigating this type of environment with their fixed income, whether it's probably ETFs?
So you made a good point before saying how ETFs are very innovative in terms of allowing investors get institutional access, and this is a good way to highlight that. I mean, with all the ETFs introduced in the market over the last 10 to 15 years, investors could really build very robust portfolios at this point, essentially allowing them to quickly reposition what they're doing in the fixed income market. So in terms of being defensive, if the market's about to turn over, typically what happens is federal bonds that tend to be more risk-free, you can overweight federal bonds and underweight credit. So ETFs allow investors to quickly do that. If you are concerned about rising rates, as I mentioned before, you could quickly shorten up duration, so go into shorter term bonds through ETFs. Another way to hedge out rising inflation risk is that there are bonds designed specifically for inflationary environments. So things like TIPS, which trade in the US, they're Treasury Inflation Protected Securities. We have real return bonds in Canada, which are very similar as well. So investors can overweight certain bonds that hedge against inflation in order to protect themselves against inflation. In terms of tactical related trades that investors can use ETFs for, as I mentioned before, credit spreads are currently wider. So if they expect the economy to normalize, over the long term, and credit spreads to tighten as a result of that, they could buy corporate-related bonds or bond ETFs that provide, some kind of credit risk. Long duration bonds, another, as I kind of alluded to earlier on, this is typically used a lot by institutions. So long duration bonds tend to be negatively correlated to the equity market, given that when the economy turns over and the equity market turns over, central banks tend to lower interest rates. So longer duration bonds tend to benefit when equity markets sell off. So a lot of investors, especially institutions, they use long duration bonds or long duration ETFs to hedge out that equity market risk. And also rate reset preferred shares, which are unique to the Canadian market, they're designed for a rising interest rate environment. Their dividends essentially will reset to the 5-year government of Canada plus some kind of reset spread. So they tend to be very effective in a rising interest rate environment.
A lot of interesting options, and it's just great. There's an ETF to cover each one of these points here, whether you are thinking about getting a little more defensive and hedging against that rising rate risk, or thinking maybe I want to be a little more tactical, I want to be a little more nimble. Where can I find opportunities in this market? There's an ETF to cover each one. So Alfred, here's a few tickers that I pulled from our ETF roadmap just to kind of go in line with the topics you're discussing on the last slide. Can you just highlight a couple tickers maybe that go in line with that defensive or tactical thought process?
Yeah, so this is essentially our 3x3 matrix. So we break up the universe into different terms, short, mid, and long, and then different credit exposures as well. But as I mentioned before, if you want to manage duration risk, you could hug the short end of the curve. If you want more yield, you could target the corporate aspect, so going into something like ZCS. But at the same time, as I mentioned before, if you want to hedge out equity market risk and get into risk-free long duration bonds, you could look at something like ZFL, which is our long federal bond ETF.
Thanks, Alfred. And then just to be clear, I know a lot of investors out there just hold an aggregate fixed income ETF like a ZAG, which is the universe, Canadian bond universe. What this kind of matrix or these ETFs are showing you is how to break down that universe. So if you hold like a ZAG, you have all these exposures within it. If you'd like to manage those exposures, shorten up your duration, focus in on credit, you can use these ETFs instead as building blocks to build that out. Now, Alfred, obviously rising rates affects the fixed income market so much more than the equity market, but it does still affect the equity market. So what about our equity portfolios? What are your thoughts there with rising rates, and how can we think about managing the equity side in this environment?
Yeah, so good point. Rising interest rates definitely has more of an impact on bonds. We talked a lot about bonds, but typically in a rising interest rate environment, equities do tend to outperform, and this is historically speaking. Obviously, it's a case by case basis, but historically, equities do outperform bonds in a rising interest rate environment. And the reason why is because in a rising interest rate environment, that typically indicates that the economy is improving. So equities, which tend to be more risky, they tend to outperform when people are willing to take on risk. So a number of ways you could position within the equity market. If you want to get more defensive, dividend paying ETFs or dividend paying stocks, they tend to outperform when rates are rising. There's different sectors you could position in terms of different parts of the interest rate cycle. So when interest rates are about to turn over, you could go into things like utilities. Utilities tend to have fixed income like properties, such as having a little bit of duration risk. So if you expect interest rates to go down, you could go into utilities. If you expect interest rates to go up, or if you expect the yield curve to steepen, banks tend to perform well in that environment, because with the steepening of the yield curve, banks essentially borrow on the short end of the curve, lend on the long end of the curve. Also, low volatility ETFs, they tend to perform well as interest rates rise, tends to bring on a little bit of equity market volatility. So low volatility ETFs are a good way to mitigate some of that volatility. But in terms of tactical ideas, or a lot of ideas for, in a rising interest rate environment, a lot of those growth and innovative ETFs, technology stocks, they tend to be interest rate sensitive. So the valuations, which were very rich, they've come down at this point. So, people that are looking for attractive valuations, may want to look at technology stocks as some kind of a long-term play, or using ETFs to get that exposure. In an inflationary environment, commodities tend to do well. Energy ETFs, as we've seen over the last 2 months, 3 months, as inflation concerns have risen, energy-related ETFs have performed very well in this inflationary environment.
Yeah, and I just want to highlight growth stocks again, because what a good example that we're all witnessing right now, how sensitive these stocks or these equities are to rising rates. Because of course, with growth stocks, their future value, their future cash flows are discounted by interest rates. So the higher rates definitely put downward pressure on them. And we've seen that throughout 2022 so far. So Alfred, let's talk us through some tickers here, just that can kind of go in line with that last slide.
Yeah, so we do have a number of what we call factor-based ETFs that provide investors with exposure to certain investment factors, whether it's dividends or low volatility, high quality, whatever it may be. But we also allow investors to target specific regions as well. So as you can see, we have dividend-related ETFs that are specific to the Canadian market, the US market as well. But we also have low volatility ETFs that provide exposure to Canada. So ZLB, for example, tends to be very popular for Canadian exposure, but also providing exposure to stocks that are less volatile than the market. On the lower row here, what you see is some of our sector-related ETFs. So we talked about banks, we talked about utilities. We also have covered call versions of those as well, which essentially provide sector exposure, but also sell call options to collect additional premium as well. But then on top of that, we talked about technology, we talked about innovation. There's also thematic ETFs that allow investors to quickly access those themes or sectors as well.
Thanks, Alfred. We got some great questions from the audience this week. Most of them actually asking about our topic today. So let's get right to those. So and a question about tightening monetary policy. I guess we talked about a little bit of this today, but this investor is thinking about hedging against these rising rates.
Yeah, so in terms of monetary policy, I mean, I guess the question is, are they tightening monetary policy because of inflation? And I would say yes and no. It's mostly due to inflation in terms of how aggressive they're tightening, but also, regardless of whether we would have seen inflation or not, banks would have been tightening anyways, because if you look at some of the economic indicators, GDP and unemployment, for example, both of those measures are essentially near pre-pandemic levels. So clearly a lot of that economic slack has been removed. So we would have been raising interest rates anyway, but not to this degree, obviously. So it's partially inflation driven, but not entirely. So in terms of protecting your portfolio, a balanced portfolio is a good way, but also focusing on high quality stocks, things like blue chip stocks, high quality ETFs as a factor, because that essentially provides exposure to companies that have strong balance sheets and have strong pricing power as well.
Thanks. And then those other ideas too, those defensive ideas, if we're thinking about the fixed income side that we talked about earlier, shortening a duration, thinking about government bonds over credit, those are some ideas there. We have an investor here who has their retirement portfolio mostly in a balanced portfolio, so equities and fixed income. As you know, Alfred, there's been no place to hide in Q1, equities and fixed income both with negative returns. So this investor just wants to know, what are your thoughts here on a balanced portfolio, maybe adding some dividends as a satellite?
I think that's a good idea. I mean, I think, when you look at a lot of these balanced portfolios, they're designed for most people, but obviously, every individual has their specific needs. So, one way to get additional dividend income on top of a balanced portfolio is supplementing with a dividend paying ETF. So that's a good way to play this rising interest rate environment. Also, may want to consider things like, tips and things like preferred shares, as we mentioned before. Those typically perform well in an inflationary and rising interest rate environment.
Thanks. This really is a unique quarter where we're really seeing both equities and fixed income drop. It's typically this doesn't happen. So next question, in the current climate with interest rates rising, what are your thoughts on utilities, pipelines as an alternative to investing in bonds?
I see where they're going with this question. I mean, when you look at utilities out of the equity market, I would say utilities are the most fixed income like, just because they do have duration risk. When interest rates go up, the utilities tend to be negatively impacted and vice versa. So I see where they're coming from. But one thing to keep in mind is that equities are never a replacement for bonds. When the equity market will sell off, utilities will behave much more like equities than bonds. So even though a lot of people have been talking about overweighting equities at this point, I think it still makes sense to have a diversified portfolio. Bonds, as we saw in the end of February, help stabilize an overall portfolio.
Great point. So while utilities may be defensive on the equity spectrum, they're still not a bond replacement. I think this is our last question. Does the ZIN ETF, so this is the BMO's innovation ETF, does it hold any Canadian companies, and how often is it rebalanced? Where are the holdings?
Good question. So it does have some Canadian holdings. I took a look this morning. Very small, however, less than 1%. I think there's 8 names in the in the index that we track that are Canadian based. Some 3 of them that I'd mention is Hut 8 Mining, Lightspeed, Nuvei. So those are some good examples of Canadian holdings, but this one is rebalanced semi-annually.
Thanks. And those holdings are just on our website, bmoetfs.com. Just click in ZINN and you can get all the holdings there. Oh, we have one more. This one's on oil. So this was our topic last week. as oil production gets ramped up in US and Canada, what does this mean for the price of gas? And maybe does BMO have an oil and gas ETF? Alfred, can you answer this one?
Yeah, this is a good one. I like this question, but essentially, Joe Biden, he's released strategic petroleum reserves, so the SPR, into the economy. So this essentially, over the short term, it's going to help soften oil prices. But obviously, the oil prices have come down lately just because the market tends to believe that the tensions in Russia and Ukraine have softened a little bit. But in terms of whether the impact of releasing those oil reserves has an impact over the long term, over the short term, I would say it does. But over the long term, keep in mind that as he releases supply into the market, at some point he has to refill that reserve as well. So he has to buy up demand. So over the long term, it doesn't really have an impact, but over the short term, it could definitely help. So as in terms of getting exposure to the energy market through an ETF, we have ZEO, which is our equal weight oil and gas ETF.
Thanks, great insight there. And just as a reminder, we did cover energy and energy ETFs last week. If you missed that section, check out our YouTube channel, because we had an analyst on from TD who, or market maker from TD rather, who talked us through their expectations on oil and gas equities and how that would change with the changing oil price. So that would be interesting to check out if you'd like further information on that. So we are going to take next Friday off because it is a holiday. So please tune back in on April 22nd. We have a really great session. That week is Earth Day that week. So we're going to talk about making a positive change with your ETF investments. And just to tease the session a little bit, we'll talk about ESG investing for sure, environmental, social, and governance investing. But we're also going to talk about how you might be actually making a positive change with your ETF investments, and you might not even know it by just holding a straight up BMO ETF. We're going to teach you what we do behind the scenes there to make a positive change. So we hope we see you on April 22nd. And between now and then, check out our YouTube channel for all our past episodes.
Thank you for watching the Market Insights webinar series. To stream any previous episode of the Market Insights webinar series, please visit www.youtube.com/ETF Market Insights. Remember to hit subscribe so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at www.etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or a recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.